Hi, I'm Anton Eser. I'm the CIO of 10X Investments, and I'm here today with Eddy, who runs our multi-asset funds, to talk you through 10X multi-asset investing. So we're going to cover quite a few things today. We're going to cover firstly how we think about asset allocation and then we manage our funds. We're going to really get a deep dive into offshore investing, obviously the Reg 28 changes last year, how we think about the offshore allocation in the portfolio. And we're going to finish off with a special topic on including global credit in your portfolio. Now that we're seeing yields higher in global markets, is it a good time to allocate to global credit? But before we do that, we want to spend a little bit of time introducing you to 10X. A lot of you in the audience won't actually know 10X as a business, and we'd like to introduce you to the business and just spend 5 minutes or so talking about us, what we do, and our multi-asset funds. So 10X as a business has been around for a number of years, for 15 years, with a 15-year track record. It was set up at the end of 2007 to really focus on the retirement fund industry to provide very simple investment solutions for retirement savings. It's grown over the years to become a 39 billion rand business. At the end of last year, we acquired Core Shares, and Core Shares is focused on the ETF and index-based business, which we purchased at the end of 2022. The team which we have now, there are 11 of us in the investment team. My background is in global fixed income. I spent 20 years of my career in London managing global fixed income and joined 10X at the end of 2021 as part of this new kind of initiative to build out the 10X investment business into a fully fledged asset manager. Eddy, who I mentioned, who manages the multi-asset funds, who will join me in a few minutes, has been with 10X for the last 8 years. Chris has been really important in building out the 10X investment business over that time and runs the multi-asset funds with myself. We're an independent asset manager, which is really important in terms of how we think about building partnerships with our clients and with intermediaries. So today, we're really here to talk mostly about the multi-asset solutions, but when I get into that, firstly, before I do, I want to talk about the other strategies you run. On the left-hand side, you can see we run about 11 billion or so in beta building blocks. So this is effectively index strategies. So if you want to own the S&P 500, you can either buy that through an ETF or a unit trust. So about 25% of our assets are in beta building blocks. And then the middle bit, which is the bulk of our assets, is in multi-asset solutions. This very much comes from the retirement business that 10X has built up over the years. So roughly 21 billion or so in multi-asset solutions. And then finally, a big growth area for ourselves is bespoke solutions. We run just over 7 billion in bespoke solutions. We work very closely with clients to design some strategies, for example, combining active and index-based strategies with them in mind. The multi-asset range, as you can see, is a very traditional, very familiar group of products across high equity, across medium equity, and low equity. We launched a multi-asset income fund at the end of 2022, our 10X Income Fund, which we launched in a unit trust at the end of last year. And we introduced that into an exchange-traded fund a couple of weeks ago. In fact, we launched the first active ETF fund to the local market in a couple of weeks ago. So we're very proud of bringing that to the market. We're going to talk about all of these funds, but really focus in on the 10X Your Future Fund. The 10X Your Future Fund was the main fund which was launched 15 years ago, ready to enable saving for retirement. It's grown into being a 16 billion rand product, so it's one of the largest multi-asset funds in the market. It targets CPI plus 5.5 with a 5 year plus time horizon. But everything we talk about, Chris and I, as we go through this presentation, really applies to all of our multi-asset funds. Importantly, the fund has done extremely well. This is the 10X Your Future Fund. 5 years into its life, so in 2012, it outperformed the peer group and has done that every single year for the last 10 years. So we have 100% outperformance since inception versus the CISA category. And really what this slide is showing you is really the importance of consistent outperformance, but also the importance of fees. Fees can really, really erode returns. And you can see there in this graph that first quartile, which is really where the fees are the highest, so 2.6% per annum, you can see that much less than 38% of the time is their outperformance. However, as you go towards the right and as those fees decrease, there's a much better consistent generation of outperformance. leading to ourselves with 100% outperformance on a rolling 5-year basis. The total expense ratio on this fund is 34 basis points. Once we add into the TIC, we get to around 38 basis points. So it really is the lowest cost product available in the high equity fund space. So the management fee of 25, then plus VAT and total TIC is at 38 basis points. So it's very important. We'll talk a little bit about that on the next slide in terms of fees. So overall, just to move on now and to talk about how we think about managing money, but overall, we have one of the largest high equity funds in the market with 16 billion rand under management. It's coming in with performance, which has been consistently outperforming, and a fantastically also low cost all in. So yeah, let's move into how we think about managing money. And what Chris and I are going to unpack in the next few slides is to really delve into how we think about asset allocation. You know, to us, asset allocation is the main driver of returns. And if you get the right asset allocation looking forward, in the end, that ultimately delivers fantastic returns. So we spend a lot of time, Chris and I, thinking about asset allocation and thinking about how we position our multi-asset funds. And we do that through 2 steps, which Chris is going to unpack in the next few slides. Firstly, is we look backwards to determine the right growth defensive split that we want to hold across our multi-asset funds to deliver the outcome. But then also, very importantly, looking forward, is we look at what our longer-term return expectations are. And the main driver for that is the current valuation that we see across asset classes. So we're going to unpack in the next few slides how we think about valuations. But the really important point that I want to note here is that this, to us, is the key part of how we deliver outperformance. Too often in this industry, we're very short-term focused. Too often we think about really what are we going to do in the next 3 months, in the next 6 months. And often what we do through that is we miss this much more longer-term opportunity that you can through generating returns. And I think back through my active management career, where I often had 3 to 5 year horizons, but often really thought about, well, what am I doing over the next quarter or even the next month? What's happening with the news flow over the next couple of weeks? And it's that noise which often gets into thinking, really, what are the big themes? What are the big drivers of markets in terms of, and the big drive in markets in terms of valuations for us is the key driver of investment returns. So we're going to talk you through how we think about that, how we think about valuations, how we stress valuations in the next few slides. And then finishing off on diversification and costs. We really believe in index management. We believe in smart construction of diversified portfolios through index is a great way to generate returns. It also manages down costs and ensures that we're not trading too frequently across these portfolios. So with that, I'm going to hand over to Chris, who's going to talk you through our SAA and valuations-based approach. Thank you.
Thank you, Anton. So as Anton mentioned, our process is really grounded in looking back over the last 120 years of data. Why? Because we start with the outcome that we're looking to deliver. So for the future fund, that's inflation plus 5.5 over a rolling 5-year time horizon. And looking back over the last 120 years, it's quite clear, in order to meet that hurdle, one has to have a high allocation to growth assets like international equity and South African equities, which over 120 years, on average, have delivered in the region of 6.5 to 7% above inflation. We start there and we look back and decide what type of split between growth assets and defensive assets we need in the portfolio. And with a 75% allocation to growth assets and a 25% allocation to defensive assets, we would have achieved that outcome with the static asset allocation, on average, 56% of the time. So on average, that static asset allocation would have delivered the outcome that we're looking to achieve. However, at 56%, there's quite a lot that one can do to manage the risk around achieving that outcome. And for us, really, we use asset allocation to do that. And importantly, valuations play an important role. Quite interestingly, if you look over the last decade, what you'll see is that the asset class returns over the last decade have differed significantly to the longer-term average. International equity is a great example, almost double the returns that one would have received on average, whereas international bonds delivered almost a third of what that average return would have been. And why? Well, the environment and the starting valuations at preceding that decade played a really important role. You can think about international equities coming out of the GFC with really low valuations, whilst for global fixed income, with interest rates held close to zero artificially for a really long time, impacted the type of returns that we received over the last decade compared to that longer-term average. Interestingly, if you flick back to the decade preceding that, so during the early 2000s, the picture effectively flipped on its head. What you can see, a powerful combination of really high starting real rates in South Africa, together with low valuations, created the environment for really strong returns to South African fixed income and equity. Interestingly, South African fixed income delivered inflation plus 5, with starting real yields quite similar to where we are today, whereas South African equity is really a strong return of about inflation plus 13, which interestingly contrasted quite significantly to the last decade. If you look at global equities in that early 2000s decade, well, at inflation plus 3, that's half of the longer term average. So really the key takeaway from this is that whilst one can set a good foundation looking back over the last 120 years, long-term time periods as much as 10 years can differ significantly from that longer-term average, and ultimately incorporating starting asset class valuations into our process is how we look to manage the risks around delivering the outcome for our clients. Starting valuations matter. They matter across asset classes, they matter across geographies. Here we've taken two examples, one being the US equities, which has been represented by the S&P 500, the other South African fixed income, so effectively South African Govie Index. Importantly, starting valuations play a significant role in determining the subsequent long-term real return. They don't have a strong relationship with the next 3, 6, or even 12-month returns. Taking US equities, we've used a valuation metric called the cyclically adjusted PE ratio, or the CAPE ratio for short. What it does is it takes the last 10 years of earnings, it removes inflation and averages that out and compares it to the current price level. With the highest starting valuation at around 26 times earnings, the subsequent 10-year real return to US equities has been around about inflation plus 3, which quite interestingly is roughly aligned to the 2000s decade that we looked at on the earlier chart. And what you can see is the strong inverse relationship between starting yield and subsequent 10-year return. As those starting valuations decrease, the subsequent 10-year returns increase quite significantly. We see the same picture when we look at South African fixed income. Here, the valuation metric is your starting yield, and the lower the starting yield, the lower the subsequent 10-year real return to South African bonds. Interestingly, we have a real yield of close to 5% currently, and with that type of environment and a starting yield on South African nominal government bonds of around about 12%, the subsequent 10-year real return has been about inflation plus 5. In US equities, where are we now? Well, interestingly, we're quite close to that highest valuation quartile with the CAPE ratio at around 27 times earnings. And with that starting valuation point, the next 10-year real return that can be expected from US equities is around about inflation plus 3. Now, it's all good incorporating valuation metrics into your investment process. But for us, the key is really converting that into a systematic, rules-based process that drives asset allocation regardless of concerns around short-term news, scary headlines, because when valuations are excessively cheap, there's often a reason for that that can deter investors based on short-term outlook, when really that key starting valuation point is important to incorporate in determining your subsequent return. So for us, what we do is we look at the current environment. So with the CAPE ratio at 27 times earnings, we really unpack the drivers behind that. So we've pulled up S&P 500 earnings, and we've compared that to the longer-term trend. And what you'll see first off is that those earnings really have a mean reversion characteristic around trend earnings. And the reason for that is ultimately earnings over the longer term are really constrained by broad economic growth. Where are we sitting currently? Well, earnings are really elevated at about $207 compared to trend earnings at about $178 a share. So what we do is we stress those earnings and say, look, if S&P 500 earnings revert back to trend, at what level do we think the S&P 500 would be fair value? And where we're sitting now at around about 4,300 on the S&P, for us, fair value is effectively 3,500. Further, we stress that even more and say, look, in these cyclical earnings recessions, on average, earnings during earnings recessions have sold off about 25% off that peak. And if we have a similar recession in S&P 500 earnings, what level would represent attractive value for us? And for us, whilst fair value will be at 3,500, the price level where we systematically decide that we'll allocate to US equities would be at 3,200. So that really talks to how we take and incorporate starting valuations for asset classes and convert that to a systematic rule that really drives our asset allocation process. When we look at SA equities, this is quite an interesting example in terms of how one has to look out over a longer term time horizon. Because if you look at the last 12 months earnings PE ratio or price earnings ratio using the last 12 months earnings, well, SA equities would really look like an attractive value opportunity with a PE ratio of around about 8 or 9 times earnings, which has really been at the lower end of that range over the longer term. However, the E component has really been driven by many cyclical businesses. You can think about resource shares that make up a large component of the SA equity market, with high and elevated commodity prices over the last 18 months, supported the last 12 months earnings. And the other cyclical component of our market being financials, really we saw a lot of the unwind of COVID provisions really supported many financial businesses' earnings over the last 12 months. So if you're in an environment where the cyclicality of that earnings is really removed through, think about it, potentially a slowdown in global growth, well, what happens to valuations? And the CAPE ratio really presents an opportunity for us to remove that cyclicality, again, understand SA equities through a longer term valuation lens. And for us, well, SA equities aren't necessarily the screaming buy that the last 12-month valuation represents. For us, they're fair value. And if you cast your mind back to those long-run average asset class returns where we really ground our processor, over the longer term, SA equities have delivered about inflation plus 7. So if SA equities for us are fair value, well, that would be the expectation for SA equities over the next 10 years. And that's where we're sitting. If you add up the 5.5% with the 1.8%, you get to about 7.3, which so we expect from SA equities over the next 10 years, inflation plus 7.3%, which is roughly in line with that longer term average. However, if you contrast the attractive opportunity on offer in South African fixed income, so from South African government bonds, expecting a return of about 5.5% over the next 10 years, well, really, South African bonds really stand out as a real return opportunity that is significantly above that longer term average and really a place where we're allocating to in our portfolios currently. What's quite interesting is when you contrast that 7.3% on offer from SA equities to the 3% on offer or 2.9% on offer from US equities, the incremental risk that you're taking on for investing in South African equities relative to South African bonds is roughly in line with the incremental risk that you're taking for investing in US equities relative to US fixed income. And really through that lens, SA bonds are an attractive asset class for us. I'm going to take a slight pivot now from the valuations view and the long-term structural drivers of asset class returns through the cycle to step back and really reassess the investment opportunity set available to South African retirement investors, with the change in Regulation 28 now allowing 45% offshore exposure, up from 30% last year. So when one looks at the Rand, it really plays an important diversification role in growth asset portfolios. You can cast your mind back to the COVID sell-off in March 2020, where we saw the Rand aggressively sell off in the face of a global risk-off environment. More recently, during the month of March, with the Lady R controversy, we saw how the Rand was really the release valve that sold off due to SA-specific risk. So we know the Rand's an important diversifier, but equally, it's a really volatile currency. And there's this natural tension between the diversification benefit of the currency as well as the volatility that it brings into portfolios. So our starting point is to always go back to the client outcome that we're looking to deliver And at inflation plus 5.5, for us, the optimal currency exposure that one should have in a portfolio to trade off that diversification benefit with the additional volatility is around about 35%. Now, there are two observations with that. The first is that under the old regime, at a max 30% allocation to offshore, well, you had suboptimal exposure to currency as a diversifier. So that's the first point. The second point is now as well, being able to take offshore exposure up to 45%. When we start from a first principles basis, when looking at diversification, we know how small South African economy is as a percentage of the global economy. From a market cap perspective, SA equities make up less than 0.5% of the global market cap. So really what we're trying to avoid is not necessarily fall into that home bias trap of over allocating a proportion of our assets to this really small open economy. And we really believe in maximum global diversification. But we look to separate out the currency aspect with the global assets opportunities that are on offer. And really, when we talk about currency hedging, which is the mechanism whereby we can separate out the currency exposure from the asset exposure, what we're talking about here is really earning the hard currency return along with the interest rate differential between the rand and global markets. So take, for instance, South African interest rates at about 8%, US interest rates at about 5%. If you strategically hedge out that currency, you're going to earn that 3% yield on top of the global asset yield. And global high yield is really an interesting asset class to view through this lens of currency hedging, because over the last 20 years, global high yield in rand terms has delivered a return of about 12% per annum with a volatility of about 15%. But strategically hedging out that currency, you've been able to deliver that same strong return at around about 12 with a vol down at about 10. So our view to the offshore question is we think that you must ultimately maximize your offshore exposure to really limit that home bias so that you can bring in as much diversification as possible. But think about how much currency you need in your portfolio from a diversification perspective based on the outcome that you're looking to deliver. When we look at really the outcome from our valuations framework, you can see the asset classes that are attractive, fair, and expensive through our lens and the resultant asset allocation. But ultimately, for us, and Anton spent many years working in global credit, the opportunity available in global credit is really important from global diversification, but also will give you an insight into how we think about implementation from an asset class perspective. Because while we focus the most of our time worrying about asset allocation as it is the key driver of returns, when it comes to asset class implementation, we really want to focus on delivering that asset class beta and not have any one single company or issuer risk that potentially could impact the broader outcome that we're looking to deliver. So Anton, if you can maybe step up and provide some context in terms of the opportunity on offer from global credit and potentially contrast that to the SA credit universe.
Great, thanks, Chris. Yeah, credit is a fantastic asset class to add to a portfolio. One of the big challenges we have in the local market is just how small and how limited the opportunities are in terms of investing in credit. So when we say credit are corporate bonds issued by large corporates into the local market and into global markets. And you can see in the chart here on the right-hand side, what we've outlined is the SA credit universe, which you can really see is highly concentrated to invest it across financials and real estate. In fact, there are only 53 issuers across the whole of the local market. And this has really decreased significantly over the last few years in terms of opportunities by virtue of just how little there is in terms of issuance into the local market. So 53 issuers, roughly 80% in real estate and financials. It really means that a lot of the issuance that comes to market gets bought up by a lot of the large insurance companies and really doesn't trade. So unfortunately, in the local market, we don't have great opportunities to add to credit, and therefore by adding to credit, you can add some yield, you can add some spread to the portfolio, and very nice diversification away from government bonds. So it is a challenge. We really do, hope that the local credit market does grow. It's very important for the growth of the local economy that we are able to finance the energy transition. So we are always looking at opportunities, but unfortunately the opportunity is very limited. And we'll talk a little bit about the spreads in the next slide as we get there. However, the global market presents much more interesting opportunities. And you can see on the left-hand side there, we have an index which we have constructed, which we track, which has got 425 names across global markets. And these will be names that you're very familiar with in terms of what you own in your global equity portfolio. So names like AT&T or Apple or Google or Walmart, all the large issuers issuing into the global fixed income market. So they'll have equity via the stock market, and there will be corporate bonds, which they'll be frequently issuing into those markets. And why is it that South African investors haven't participated in global credit, whereas they've been very active in investing in global equity? And this kind of ties to this point that Chris was making, is that previously when the offshore limit was 30%, you took that full limit up to the full 30% into equities, and you didn't really invest in credit because it really was a wasted opportunity relative to your equity exposure. But now that we're at a much higher limit, we need to start thinking about other opportunities. And global credit provides a great opportunity for us in terms of accessing global markets. The index we've constructed is a blend of investment grades. That's BBB rated corporates and above, and sub-investment grade, which is BBB rated or below. Now you'll think about, for example, the South African government bond. We're a BB rated sovereign issuer. So a lot of the market here, banks, etc., are therefore sub-investment grade issuers, whereas in global markets you have access to much higher quality names in terms of default risk. And that's really played out in this slide here, which you can see. So what we have in front of you is on the right-hand side is talking about SA credit, which you can see I mentioned that BB rated, which is a sub-investment grade rating, spread of around 120 basis points. Comparing that to the global high yield market, which is an average rating of also BB, where the spread is 450 basis points. So that's 4.5% spread over the risk-free compared to 1.2%. So you're getting close to 4 times the amount of spread for the same amount of default risk. So it really does make no sense in terms of allocating locally compared to that opportunity that you have in global markets. And it's important just to add to the point that Chris made, is that when we think about this allocation, the same way we do in equity, same way we do in credit, is we see it very differently as a separate allocation decision to our currency exposure. We will hedge the currency risk, we will hedge the rate risk, and what we're trying to capture is that additional spread that we're adding to the portfolio. And if you recall from the slide that Chris put up a few minutes back, is global high yield currency hedge was one of the best returning from a risk-adjusted basis asset classes over the last 20 years. So from our perspective, because we don't have this local stock selection bias, what we really focus in is on asset allocation. Once we've made that asset allocation, we are very indifferent as to which markets we need to go to. We're not biased by virtue of our coverage of the local market versus foreign markets. And we're able to invest globally and therefore access these markets, which previously are markets where, as local investors, you would not be investing in. So it really points to this point around diversification, accessing markets in a way which is sensible, not just pure passive, but investing in markets which gives us that diversification that we're looking for. So we've covered a lot of ground. I finish off here talking about how we can add global high yield and global investment grade to a diversified portfolio. Chris spent a lot of time talking about asset allocation. It's really for us the most important driver in terms of how we think about portfolios. And as an investor, your asset allocation and how much you invest in the local market and how much you invest in the offshore market and the currency exposure really generates the greatest majority of the return across your portfolio. And it's hence why we spend all of our time thinking really about that asset allocation, the currency exposure, focusing on valuations, and understanding where the opportunities sit in markets, but really looking out over a long term. We're not trying to generate this kind of short-term tactical return. It also presents great opportunities in terms of when you look at markets, you're able to invest in markets like global credit that I've mentioned. So thank you for your time. It's been great to try and introduce 10X to you, but also importantly talk about how we think about managing money and the importance of long-term investing the importance of diversification and the importance of managing costs down across the portfolio. Thank you for your time.